Good morning.
Well, good morning to you. How are you doing today?
I'm doing great. It's a nice day. Yesterday was sunny. Today is kind of gloomy, but the weather here is getting a little bit warmer. It's still cold at night, you know?
Really? Oh my goodness.
Yeah, I
It's
was
it's
surprised that, summer is approaching. You would hoping that it would be a little bit warmer, but it's still chilly. Yeah.
well, I'm not going to complain because they have said that Vegas has gone from sort of early spring into straight it's getting warm. It's like this week 100, 105 is
Oh my
the
goodness.
highlight of I think Friday or Saturday. 105.
Oh wow, that is hot.
It's
You need to come back
how
here in
good
Southern
to be
California.
Well, everyone, welcome to another episode of Wealth Doctors. I'm Dr. Stephanie Ardrey, and with me is Dr. Andrea Lee, and we are your host for another episode of Wealth Doctors. Hey, what are we talking about today?
Well, today we're talking about a very exciting topic. It's called TFRA. It's a tax-free retirement account. What is it?
Tax-free?
Tax-free.
Tax-free. Okay.
Tax-free retirement account. Everybody is interested of mitigating taxes or reducing taxes or find ways to minimize it. So this is one of the accounts that can help you to achieve that.
Oh, excellent. I was, like
Yeah.
I mentioned before we went live, is that I was talking to a colleague that I was suggesting that we sort of look at a comprehensive plan that includes not only estate planning, but also financing for a new business that he's launching and, kind of transitioning into, the second career. So he's retired from one career
Right.
and now he's building his business. And so it's like, well, let's really think about, number of variables and look at them holistically so that we can formulate not only diversification in your plans, but also making sure that you have access to capital, different types of capital. You have the ability to find liquid assets when you need them, while also having assets that are doing work, continuing to make you money and hedging your overall bet across your portfolio.
Right. Having liquid asset is very important because we do, part of that is an emergency fund that you want to set up for about 6 months of your expenses set aside, just in case something that you need to access that money right away. So it's important to set that up. But at the same time, we have an account, as far as investment, when you put money in the stock market, you have the liquidity. You can access that money pretty quickly. However, your money is a lot at risk. I mean, risk is good. I mean, you have an opportunity to gain, when the market goes up, right? But if the market goes down, you also capture all that losses. And having too much risk is not good. Enough
Right.
risk is okay, but too much risk is not good. And especially near retirement, when you have less than 10 years toward your retirement, you cannot afford that much risk. So this is the balance where you have to find out where you are in your retirement, when you want to retire, and where you are right now, and how much have you saved so far. Where do you save that money is very, very important. Just like, when you're trying to uh, depend on a crop to live, right? Like, let's say you depend on orange tree to live. Now, where to plant that orange tree to grow is important. Do you plant, I've heard it before, do you plant in Florida or do you plant in Alaska? Where would you yield more crop to sustain you? So obviously, where you save that money to grow that money is very, very important too. So today we're talking about TFRA, which is, one of the account that potentially, you should incorporate that into your portfolio to see, it will fit your retirement goals or where you're going. At this point, there are um, accounts that like tax defer, or tax free. Which bucket of money would you put your money in for retirement, especially, or for investment opportunities? So the tax now bucket, we're talking about brokerage account like Swap, Robinhood, stocks, bonds, mutual funds, CDs, and savings. So those are the accounts that you already have, but how much you allocate to those accounts is very important, because you know you don't want to put all of your money at risk or too much risk, and then that will, especially near retirement, you cannot afford that much risk as far as time horizon to consider. And the tax defer bucket is, we're talking about like 401k, TSP, 403b, annuities, or at work, you may have for the most common one is, the popular one is the 401k, very well known, and those are just tax defer. They're not tax deductible. It's tax defer. A lot of people misunderstood that it is tax deductible when you put the money in there, and when you take it out for retirement, you don't have to pay tax. And that is a big misconception, because you do have to pay tax later on. So now you don't pay tax on receipt, but you're paying tax on the harvest when you take out the money at retirement. And RMD is the required minimum distributions at age 73. And again, not a lot of people are aware of the RMD rule. So it's important that if you near retirement, look into this, this rule, and make sure that you're taking out your money at 73. Otherwise, there is a high penalty for that if you don't take it out.
Yeah, it's really important. And I think that that's a lot of times people, we get so busy, living life, that so many of these things are happening around you. That's why I say it's great to create little reminders. So just like you do an annual health exam, you should do an overall holistic well-being
For
exam.
financial,
You should
right?
also do a
Mhm.
financial assessment. I would say an annual, assessment. And it makes sense. You have the opportunity to pull, for example, you get a copy of all of your credit reports free annually for that reason, because it's a real understanding that it's important to check your status. If someone has stolen your identity and you haven't pulled your reports. I mean, that was the shocker that I learned, is that not only had someone stolen my identity, they'd bought a home in a whole nother state
Oh,
that I had
wow.
never visited. And so, trying to unravel those things once you learn of them, when you've been unaware of these kinds of things happening. So it's important to just be aware of what could be happening, with you, and seeing if you can identify some of the plans that you have, so that you can be in a position of making proactive decisions, rather than having to be in a sense where you're reacting to circumstances that have been presented. There's some markers that we can pretty much say are typical things that are going to happen if you're blessed to have your parents, and your parents are aging. You do know, as they age, they may potentially experience different things.
Mhm.
Sometimes they go into a phase of early dementia or Alzheimer's, so they begin to experience cognitive issues. They may have other chronic or lifestyle issues. So if you're a caregiver, you have to take that into consideration as well, because it's not just the time that you may have been planning about what you're doing for yourself. If you're a caregiver, if you have young children, or if your children are young adults and they're trying to adult, they still need oftentimes support. There's expenses, and it's
Right.
significant expenses for young adults to establish their own households when they're looking to begin, their careers and formalize their independence. So again, as parents, oftentimes we're still needed to
Mhm.
provide, support to help fill that gap for them. And so, of course, if we're in a position of strength, then obviously that's helpful to be able to assist. And so, just kind of thinking about what the possibilities are, and then what are even some unknown variables that you might find yourself dealing with and needing to address that you hadn't considered. Hopefully, those won't be as devastating if it is that you've I always say, let me plan for the things that I can so that I leave space for the unknowns.
Right. I mean, there's a lot of unknown out there, and sometimes we're scared, but um, doing an annual review, like you mentioned, it is a great way to identify which area of your financial need that can be addressed, or can be changed, or can be adjusted. Especially, today our main focus is the tax-free retirement account. So we'll zooming back into this one is what are the tax-free retirement account that you possibly could have? And people are really interested in this bucket because, again, tax, right? Tax. What do you think the future is? The tax going up or going down? What do you think?
Well, I would say that it's going to increase, but also you have to realize is what are the deductions? And that's a
Mhm.
lot of times the thing that people um, misunderstanding is that typically if you are a W-2 employee, for example, then you have a number of taxes that are withheld from your regular paycheck. Some ways to mitigate those tax expenses, I always encourage people if you are a W 2 employee, it's a
Mm.
perfect time to begin a business on the side so that you have some type of business offset and expenses that you can begin developing while you are an employee and have the benefit of consistent income that you can use. And so that'll give you deductions. Obviously, if you have children, if you have other dependents, that will help you with some deductions. If you have real estate, then
Mhm.
the mortgage interest rate is typically a deduction that you would have. But if it is you find yourself later in life where your kids or whatever dependents, your dependents are no longer there,
Mhm.
your home is free and clear, so you no longer have mortgage deductions. You may find yourself with a higher tax liability because you don't have things to offset your taxes. And so if you're looking at being taxed on those capital gains, but then it's based upon the income bracket, but
Right.
maybe if you're on fixed income, you go into a lower bracket, depending upon how your income is reflected. So all of those things are things that one needs to be able to consider and
Right.
think about then as a result of this, then what would my
And
liability.
with the tax-free retirement account, that is a great way to incorporate that into your portfolio, because then you don't have to worry about the tax deduction, and it is tax-free to access that money. So we're talking about municipal bonds, Roth IRA, TFRA, which is tax-free retirement account. Now, with municipal bonds, I mean, there is limited. You can invest into that, but again, the interest rate may be low. That's why it is tax free. The interest may be low, and the Roth IRA, which is a lot of people love the Roth IRA, right? The Roth account, because it is tax free when you access that money down the road. But there is a limit of how much you can contribute per year, and it does have an income limit as well. So this Roth is not going to be it's not going to be for the high income earners. When you hit certain threshold, income threshold, then you cannot qualify for it. And it does have a lot of restriction as well. I mean, you cannot take the money out before 59 and a half and income limit. And again, the most important thing is your money is at the market risk also, because it's based on the market volatility. So if you don't know how to invest that portion that you put in inside an account, that money can be at loss or at risk. So it's important that you monitor. If you have a Roth, monitor that account to make sure that you're earning an average rate of at least 6 to 8% or so, to compound over the years. Now, the account that we want to focus on today is a TFRA account, which is tax-free retirement account. And what is TFRA retirement account? If you look under IRS section code 7702, this is where the TFRA is utilized for the tax-free code, that you can access the money when you have this account opened, or you have this account in your portfolio. So look at, anybody interested, look at section 7702 in the IRS, and you'll see this. So part of the TFRA is setting up, utilizing the insurance umbrella to create an account for the purpose of cash accumulations and the purpose of growing your wealth in this umbrella, and access the money tax-free, like, when you retire for tax, for income, lifetime income. And at the same time, it does have all the benefits, but the most primary reason that why we have this account is for the cash value, and building up an asset for you that, unlike any other account, that you don't have a contribution limit. You can contribute whichever amount that you want. And because it's not subject to the rule and laws like the 401k, so it does have other benefits that 401k doesn't have. With less restrictions in terms of access that money early to do whatever liquidity. We mentioned about liquidity earlier. It's important that you have that access in order to get that money out for whatever reason you need: vacation, emergency fund, medical expenses, or your kids having a wedding, you're getting married, buying a house, buying a car. Now that is acting like your own bank. You're almost right. You can access that money anytime that you need. Just recently, last 2 weeks ago, I just helped a client access her money. She had opened an account and put in a big chunk of her money into that account with intention to save it for retirement. But now things comes up, she needs to access some money, and I was able to submit and help her just submit a simple form, and her money was in her account like 4 days later.
Yeah.
That's how fast it is.
That's the part that people forget, because again, even as I mentioned, I'm always, I'm pro real estate. I love real estate, but real estate does not always provide you with liquidity, because you still have to qualify through some type of lending institution, oftentimes, to access the equity in your property. So it's not the most liquid form of access to your capital. Whereas if you have different life policies, it's about just being able to request a loan against the funds that you have, the cash value that you have, and that's instantly available.
And the equity line of credit too, right? If you have equity lines or a credit, in the real estate, it takes time to apply for that equity line. Right now we're talking about 1 or 2 months in order to access that money, and she couldn't wait for that long. Sometimes you need the money, you need it right away, right?
Absolutely.
So, and this is where that you can access that money. And what the beauty about the TFRA account is that when you access that money, your original principal is still grown as if you didn't take out that money. Would your bank do that for you?
Not
If
at
you
all.
have 100K, you take out 50K. I mean, you only have 50K, right? You don't compound interest based on 100K. But the TFRA account is completely different. I mean, that's one of the beauty of having a TFRA account. And another thing is the market it is mitigate the market risk too, because your money is in the index strategy, which is indexed to the market, but it's not in the market. So you're not subject to losing your money if the market goes down. So we're talking about zero floor, the power of zero, meanings the year that if the market drops all the way down like negative, then okay, you won't earn anything that year, but hey, you don't lose a dime, right? You don't lose anything. Whatever you have in there, it is yours, and whatever you gain up to that point, it is yours, and it's keep compounding from there. And when the market goes up, it's appreciate and picked up where it were, and it just keep going up. So that's what I love about this TFRA account, because the opportunity to grow and appreciate and eliminate the downside risk.
Absolutely. And I think that that's what's important. I was listening to a program a couple days ago, and they were interviewing this gentleman. They call him the Indian equivalent of Warren Buffett. And he was sharing both an opportunity that he took to have lunch with Warren Buffett. Oftentimes Warren makes himself available through charitable causes, and
Mhm.
you can bid on having a lunch with him. And so he shares this story about how he bid on and he had lunch with him, but how he was struck by Warren's intention behind this lunch. It's not just, casual. He's really looking to impart some of his knowledge, his investment strategies and things of that nature. And in this one particular case, not only did he offer, information to this gentleman, but he also told him that he should meet his partner, Charlie Munger, the late
Mm.
Charlie Munger. And so luckily the guy did have an opportunity to meet Charlie, and then they developed, relationship and all of that stuff. And so in his conversation, he was talking about a number of things, but one of the things in particular was really around why certain people tend to be drawn to, if you will, certain people, right? In terms of what it is that they're doing, their thoughts, their behavior, their beliefs, they're making certain decisions. But also, he talked about even when you consider Warren Buffett's long term averages in terms of, determining outcomes for the company, that still there is room for error in some of those investment strategies. And until you've had an investment for a long enough period of time, it's hard to really know if it's going to produce the outcome, or if it's producing the outcome, there are times that you wish that you would have doubled down and increased the investment so that you could get a greater return. And
Mhm.
so what I took away was not only the importance of, recognizing that diversification is important, but also being able to stay the course, recognizing what tools are going to be really tools that you believe in and that you lean into for a long-term strategy. Doesn't mean that you don't evaluate the performance, because you do want to make sure that you're taking into consideration the various variables that are happening, the global economy, what's happening in the global economy, what's happening in your micro markets, what are the migration patterns, what are the shifts in industry and sector, what is the political climate, all of these things, what are happening as it relates to the resources in the environment, and how does that contribute to overall economic stability. All of these things are things that go into what determines the
Mhm.
outcome. It's what determines the outcome of industry. Industries exist to support consumers, be they B2B, business to business consumers, or B2C consumers. So it's important, a lot of times we forget all of those different moving pieces that make up and overall economic reality for not only businesses, but us as individuals. We're working to create income to take care of our families in a day-to-day basis, but also we have to plan for our later years in life. What happens as you hit a age that maybe you can't work, or maybe you don't desire to work, you want to retire from working. How do you sustain yourself, your lifestyle at that particular point? And what might be some variables that you need to consider, long-term care and all of these other things that you need to factor in.
Yeah, and the long-term care and the to ensure you have enough money for retirement is very, very important, because now we live in longer, because medical advancement and all of that. So do you have sufficient amount where you retire comfortably, and you're able to travel, you're able to do things that you like. So the TFRA accounts, again, I mean, it's not a qualified plan. So it's not subject to the tax rules of the 401k or the Roth. It's very similar to the Roth. It's considered like a super Roth, because it has all the tax advantage, but at the same time it has so many other benefits. Like when you set up an account, it comes with long-term care protection, or the chronic care protection, and the ability to access that money early without penalty. Because with the 401k plan and the Roth, if you access that money before 59 and a half, there is a penalty.
Mhm.
A very hefty penalty, and people didn't realize it. I mean, they go into their 401k plan and access the money, and then they end up getting taxed like 40%, with along with the penalty. So that's quite a lump sum when you need to access the money early. Again, the tax free, the TFRA account, have all the benefits, but minus all the negative side of the 401k or the Roth, that you can access the money early if you need to use that money. And the income, also the income generated is tax free later on for your for lifetime income purpose. And a lot of business owners are utilizing this strategy to fund their business. So if you have a large amount of money, we're telling people that just sold a house, won a lottery, or won a lawsuit, that you have a big chunk of money, you don't know what to do with that. There is a way that you can set up to protect that money. So TFRA is an account that helps you to protect the money that you don't want to lose,
Absolutely.
and
And
not at
trust
the
me,
market risk. Yeah.
yeah. And even just having those funds sit in a bank account, you're losing, because it's not even
Inflation,
with
right?
inflation if it's sitting there. So,
Right.
think about that, is sometimes where you think, you're not losing. And then also when you think about, even you mentioned some of the municipal bonds, it's important to make sure that at least the rate is higher than inflation, because that's also the other thing that, again, you don't control. The when we're doing, if you will, a SWOT analysis, your strengths and weaknesses, those are things internally that you control, but opportunities and threats, those are external, outside of your control, just factors that happen. And so the threats being not only the obvious ones around yourself, but what happens if right now we're talking about just the amazing amount of inflation in the market, grocery prices, buying food, the prices have gone up. People are seeing a 30 to 40% in some case increase on things that they normally purchase. And those types of increases are just not sustainable, especially if it is that you're working on a particular budget that you're trying to manage within
Mhm.
a certain amount monthly, and something suddenly increases by 30 to 40%. You notice that.
Right. I mean, it's we're talking about inflations and tax, and again, your income doesn't correlate. I mean, every year the inflation is about, they say about 3%, but we actually seen it more than 3%, right? And the raise is probably what, 1%, which is not enough to make up the difference between the inflation and the raise for, for an individual that trying to make a living. And the other day I was just talking to a friend regarding his rent. He was saying that his landlord is increasing his rent at the rate of 7% per year.
Wow.
And I've seen 6%, 7% per year. And that seemed like the normal rate right now. But
Wow.
that is a huge increase when you're talking about your paycheck staying the same, but everything else increases. So
Absolutely.
here's the opportunity. Like if you have the money, or you set aside, you have to set aside something for yourself. Because imagine you in your working years right now, you have trouble saving. Would it be harder for you to save now, or is it harder for you to save when you're not working, when
Mhm.
you no longer have an income? It would be extremely difficult to save, right? And then you have less time to grow that money. So
Mhm.
times and how much you save, where you save it, and timing, very, very important. So the TFRA account will give you this advantage edge by protecting your money from the stock market and growing, based on the indexing strategy that allow you to capture the gains only. And it has so much other benefits, like people that again, if you're not into risking money in the stock market, this is where you can park your money for a safe investment. And and it has so many other benefits, like no maximum uh, contribution like the 401k or the Roth. So for the wealthy, or for people that have money that want to allocate, this is an opportunity that you can have an account that grow that money over time. We're talking about compounding interest. So it's important, if you have 10, 20 years and you have a large chunks, it's important to have this account as part of your portfolio to help grow, protect, grow, and access money for lifetime.
Yes. Well, as usual, our conversation and information, I tell you, these weekly conversations are great. They're definitely short and sweet. We hope that you enjoyed and gained some insight, at least added a little thoughts to your considerations and contemplations around how you're creating your wealth strategy. Every Wednesday, 10 a.m. Pacific time, Dr. Andrea and I offer this space to have a conversation about creating wealth and what type of tools we like to see put into play to contribute to that potential outcome. What do you think, in terms of any last thoughts before we conclude for this week?
I if the information is helpful, please drop a comment, or if you have any question, please drop a comment. We'd love to hear from you. Anything that you want to learn, or you interested in, or anything that think that we can improve for our show, please let us know, so that we can make it, your time valuable. Your valuable times are worthwhile being with us here. So we really appreciate that you joining us, and joining us weekly and listening. And we wish that you have the most wonderful day. And until then, and then if you have a plan, or you don't have a plan, or trying to find out where you are, or don't know where to start, reach out to us. We are here. You can email us at info@welldoctors.us. And we will respond right back, or drop us a comment.
Excellent. So until next week, take care and we'll see you soon.
Thank you.